Hi, welcome to my channel. Thanks for tuning into this video. In this video, we're going to be looking at Warren Buffett's 2016 purchase of Apple, why it was such a fantastic investment. And hopefully, we're going to be looking at what Warren Buffett saw in this purchase, what made him decide to go through with it. And I'm going to be looking at it in the context of my own sort of investing framework, which is based very heavily on Warren Buffett. So we can get started, and let's start off really with an overview to begin in terms of what Warren Buffett looks for in a company. So when he's looking at a company, what he's looking for is a company that's able to earn a lot of money, a lot of free cash flow, a lot of earnings, and grow those earnings over the next 10 years with great management, low levels of debt, high returns on shareholders' equity. And he's looking to buy it at a good price. So he's looking for great companies at good prices. And so I think Apple definitely fits into that in 2016 when he bought it. So let's look at it together. What I'm going to do is I'm going to open up my own investing checklist, which is based very heavily on Warren Buffett's checklist that he goes through. And we're going to be looking sort of line by line through the checklist at Apple in 2016 to see why it was such a fantastic purchase. So let's get started. So I'm going to open up my checklist here. The first thing, and this really comes down to circle of competence, is that the company produces products or services that I can understand. So this is my entire checklist here. As you can see, it has about 41 points, and it's growing as I learn more and go along. But right now it has 41 points. I think a couple weeks ago it had 43, but then I kind of merged a couple things together, and so now it's a little bit more straightforward. But what we're looking at is companies that pass our entire checklist, more or less, with a couple of exceptions on some of the points that are more optional and less important. But the first point, and probably the most important, is that the company produces products and services that I can understand. That is arguably the most important point when it comes down to it. So what we're looking for is a company that produces products or services that I can understand. Now, if we're in Warren Buffett's situation, I mean, iPhone is kind of an advanced technology, but it's essentially a cell phone that has a big fan base around it that people really like. So it is a product that I understand, and I understand quite well myself as a user of it. So that's sort of the first point. We can say that that Apple sort of checks that off. The second thing is that the company sells these products or services to more than a single buyer, ideally lots of buyers. Well, we know the iPhone, people buy them individually. People buy an iPhone every year or every 2 years. So this is something that people buy, and it's not like a single buyer. It's not like Apple makes this and only sells it to one company. They sell it to millions and millions of people. So it passes the second point of our checklist. The third thing is that the company's market share in the industry is increasing and will continue to increase over the next 10 years. And what we can see is we can look up the Apple iPhone market share here, and we can see it by year. And we see from 2007 all the way up to 2015, there was a good substantial growth in Apple's iPhone market share compared to its competitors. And we can see in this chart over here as well, it went from a 3% market share in 2007 all the way up to a 16% market share in 2015, showing substantial growth in its market share over time. And since then, its market share has remained relatively stable globally at about 15 or 16% on average. So we can say that it passes our first three checklist points, which are that it produces products or services that I can understand, that the products and services are given to more than a single buyer, and that the market share is increasing and can continue to increase over the next 10 years. And we know it can continue because there's still room for growth. We're only at 15% of the market that's captured. The next point is that what the company does will very likely be relevant in 20 years' time, meaning no fidget spinners. No fidget spinners. If you remember, fidget spinners were a fad. We don't want fads. We don't want things that come and go. We want things that are going to be relevant in 10 or 20 years' time. The iPhone, it's hard to predict exactly where this sort of technology is going to be in 20 years' time, whether it will be obsolete. Obviously, Apple continues to sort of update its products. Now I believe they're on the iPhone 13 or something along those lines, iPhone 14, I don't know. So we don't know 100% if what they're doing is going to be relevant in 20 years' time. Let's look at an alternative. Starbucks. Starbucks makes coffee. Will it be relevant in 20 years? Absolutely. Will the iPhone be relevant in 20 years? This is going back to 2016. Is it going to be relevant in 2036? We don't know. So we have to put a question mark on this point. It doesn't mean that we can't make the investment. We just have to be very cautious. The next one is that the company is relatively well known in its market. Of course, Apple, everybody knows Apple in 2016. Everybody knew Apple. It was well known in its market then, and it still is now, obviously. Now, point 6, the company's outstanding shares have decreased over the past 10 years. That's a good question. We got to look at it. So what I have here is on Y charts, I have Apple's ordinary shares number. issued or quarterly. And we can see that from about 2013, it was buying back its shares over about a 2-year period. But it did increase its shares. So when Warren Buffett was looking at it, it had about 22 billion shares outstanding, or something, 21 billion maybe. That means that over a 10-year period, it actually increased the number of shares that were outstanding. So it was increasing them, and then it was just starting to decrease and buy back its shares. So is it buying back its shares? Is its shares getting smaller? Yes, but not over the larger period of time. It was like more recent, those shares were being bought back. So, I mean, it's okay. It's not ideal. Obviously, we would like to see the shares go down, go down, go down. It was more like it was going up, and now it's starting to come down again in 2016. So that's that for you. The company's payout yield is higher than the going AAA bond yield. So if we look at the payout yield, which is the dividend yield plus the share buyback yield, we want those two combined to be higher than the going AAA bond yield. Now, I believe the going AAA bond yield was something along the lines of 3% in 2016. We can look at what the payout yield was. Net common payout yield. And you can read here, it's what the amount of payouts through repurchases and dividends that a company pays divided by its market cap. And we can see that in 2014 and 2015, it was around 7 or 8%, somewhere 5, 6, 7, 8%, which is higher, definitely higher than the bond yield. And we see our point here that the company's outstanding shares have decreased, and the company's payout yield is higher than the going AAA bond yield. Going AAA bond yield 2016 was probably like 3% or 4%, something along those lines, maybe 5%, I don't know exactly. But I know that at 6 or 7%, this yield here is definitely substantially higher in 2015, 2016 than the going AAA bond yield. So this passes that checkpoint as well. Finally, or next is really point 8, which is that the company's earnings yield is higher than the going AAA bond yield. Now, if we say that the going AAA bond yield is about 4% or something along this time, then that means that the earnings yield has to be at least about 6%. So we can see what the earnings yield was at that time, which is basically the earnings of the company per share divided by the share price. And we can see that in 2016, when Warren Buffett bought it, it was about 8%. 7 or 8 or 6%, 6, 7, 8%, which is definitely 1.5 times higher than the going AAA bond yield. Next, the company has a fan base, or at the very least is what most people think of when they think of a product or service. So what does that mean? That means if you think of cell phones, you think of iPhone. Probably is like the first thing that you think is going to be like iPhone. So it has a fan base. People like it. They buy it every single year. Those are the products that we want, where people are going to keep on coming back. Just like Coca-Cola. Okay, Apple provides a product. It's the iPhone. People go, they want to keep on buying it. They want to keep on buying it. They're a fan of Apple and their products. They're a fan of, the Macs. They're a fan of the smartwatches, the Apple Watches, and they're a fan of the iPhone. So the company has a fan base, and that's a good thing. That's what we want to see. Point number 10 is that the return on invested capital, return on equity, return on assets, cash return on invested capital, and return on capital employed are all increasing and at least double the industry standard. All we got to do is take a look at these numbers one by one and show that in 2016 and 10 years before, they're going up. They're going up. So the return on equity, we can look at the return on equity annual, for example, and we can see that the return on equity here was very high. From 2007 all the way up to 2015, look at this. It's almost like above 30% every single year. That is absolutely fantastic. That is what we want to see. The return on equity is high and it's going up. It's high and it's going up. That is exactly what we want to see. So when Warren Buffett was looking at this, he saw that the return on equity was high and it was going up. The next thing was the return on invested capital, and we can look at that as well. I'm not going to go through every single one of those metrics, but you can see that the return on invested capital was also extremely high. Anything basically above 15% is excellent, and we can see that it was substantially higher than that throughout 2015 and 2014. Almost double at about 30%. So we are. It's definitely passing all of these metrics. And the return on equity is above 25%. Yes, return on assets above 5%. We can look at the return on assets annual, see what it was in 2014 and 2015. 2014, way higher than that. 2015, way higher than 5%. So we are good. And like we said, the return on equity was extremely high as well, way above 25%, something like 30%. Profit margin is increasing is another point that Warren Buffett, of course, looks for. So we can see profit margin. And we're going to take a look and see what it was. We can see that it's been going up and then remained relatively stable, but it was relatively high, about 22%, and that was increasing substantially from 10%. So over the last 10 years, the profit margins have doubled. That's a very good sign. That's what we want to see. So it passes that point as well. And the profit margin is higher than the industry average. That's definitely the case. The next point is that research and development is below 10% of revenue. And the reason for that is we don't want companies that have to plow a lot of their money into research and development. We want companies where a lot of research and development is simply not required. So we can look up research and development. And we can see what percentage it was of annual revenues. And we can see that it was, in 2015 and 2016 and 2014, less than 5%. So when Warren Buffett bought it, he saw that the research and development was less than 5% of the revenues. The requirement is we want it to be less than 10% of the revenue, and it is. So this is a very good sign. This is something that we really want to see, that the research and development is below 10% of the revenue. Next, the property, plants, and equipment are less than 15% of the assets, and this is because it's a non-capital intensive business, which is what we want to see. We want to see that this is a non-capital intensive business, that the company doesn't have to invest a lot of money into its properties, plants, and equipment. And we can look that up here, in terms of properties, plants, and equipment. Or if I go to browse here, I can see based off of the balance sheet, what the basically what the gross PPE is as a percentage of annual assets. And we can see that it's not too high as a percentage of the total assets. Next is basically our growth metrics, which is our revenue growth, our net profit growth, and our free cash flow growth, which is what we're going to be looking at. So we can look at net profit annual, and we see how that's really been going up. We can see free cash flow, same thing. It's been going up. And we can see revenue. Same thing. It's been going up. So the company's been growing in terms of its revenue, in terms of its free cash flow, and in terms of its net income, which is excellent. These points here is basically all management related. Now, I encourage you to look them up yourself. I use Glassdoor. So what I do is I go on Glassdoor and I see what the employees say about their management. If the employees love the management, that's a good thing. If Glassdoor has the company highly rated, like a 4.3, 4.4, 4.5 or higher, that's really good. That means that the employees really like their managers. The employees are having a good time. They enjoy their work. That's a good sign for a company. So I use these as my personal metrics. We're not going to go through them. I don't know if I can even find that data for Apple in 2016. But what's important is that the management it is liked by the employees, basically. It's a very good sign when that happens. So I encourage you to go on Glassdoor when you're evaluating a company. This is part of my personal checklist, but we're going to skip over it for now. The next thing is that the company can pay off all of its debt within 3 years of current sustainable earnings. In order to do that, we need to figure out what the current sustainable earnings are and what the long-term debt is. So if we look at, Apple's we can just look at net income. And what we're going to do is we're going to take the average of 2015, 2014, and 2013. So if we look here, 2015, 2014, 2013, we can average those three to get its current sustainable earnings power. So 53.4 is what it was in 2015 plus 39.5, which was in 2014, and then 37.04. We get those three numbers, we average them out, and we can say that Apple's sustainable current earnings power is $43 billion per year. Now, what we need to do is we need to look at the long-term debt situation in 2015. So we can see long-term debt. So remember, Apple has a current sustainable earnings power of $43 billion per year. And in 2015, it had $64 billion worth of debt. So what we're looking for is for companies that can pay off all their debt within 2 years of current sustainable earnings power. So if Apple is making $43 billion a year in current sustainable earnings and it has $64 billion worth of debt, it can most definitely pay back all of its debt within 2 years of current sustainable earnings. So it passes that point. That's what we want to see, a company that doesn't have too much debt, and it's really good. I say 3 years here, but you know what? I'm changing my mind more and more towards 2 years worth of current sustainable earnings. So either way, it definitely passes it at 3 years, so we're okay. Earnings power value can be computed. The earnings power value is just simply the current sustainable earnings divided by what our desired rate of return is, or the weighted average cost of capital for the company. A weighted average cost of capital for a company like Apple, in this case, making $43 billion a year, we're looking for a percentage figure that would represent our sort of rate of return. If we say that we would want a rate of return of at least 9 or 10% of on our investment, we can do divided by 9%. And that gives a value, basically, of Apple at $481 billion. We take the current sustainable earnings divided by our desired rate of return, and we get a value of $481 billion. And we can compare that to the enterprise value. And what we'll look at is the enterprise value in 2015, 2016, we can see that the earnings power value is less than the enterprise value. So the enterprise value is higher than the earnings power value. That would indicate to us as investors that Apple might be overpriced, but Apple as a growth stock is not evaluated simply using the earnings power value. We rather look at the earnings return, which is a different method and a method that's better used to evaluate growth stocks, which we're going to do in just a minute. So now that it can pay off all of its debt, we can predict its earnings power value, future growth rate can be predicted. Now, to predict the future growth rate, what I like to do is I look at revenue growth because it tends to be slower. If we look at the annual year-over-year revenue growth of the last 3 to 5 years, it should give us a good sense of what our expected growth is going to be for the company. And we can look at the growth rate in 2015, 2014, 2013, 2012, and get a sense of, how the revenues have been growing and what they're likely to grow in terms of the future, and compute a sort of average growth rate, basically. Well, another thing that's really good with Y charts is if I look at revenue growth, let's say 5-year growth. If I get this number here, this basically shows me what the average revenue growth has been over the last basically 5-year period. So it's extremely high. It's an extremely high growth rate. I never use a growth rate above 20% for all of my computations. If it's a good buy, it should be a good buy at maximum 20% growth rate anyway. So I will always cap my growth rate at 20%. If we go back and we look at the annual year-over-year growth and we figure out the average of these numbers, it would equal this anyways, which is 29%. 29% is way too high. I'm going to say that the growth rate maximum will be 20%. We can look at net income growth as well, which tends to be a higher number almost always than revenue growth. And we can see that in 2015, it was very high as well. So these are very high numbers. I don't like using a number that's higher than 20%, but it's up to you ultimately what it is that you want to do. So future growth rate can be predicted. I mean, we're saying it's going to grow at 20% per year maximum, given that the numbers have shown that it's substantially higher than that, but we're capping it off as 20%. We're not going to use a number higher than 20%. And we can even look at free cash flow, 5-year growth as well. Try and figure out what it was like in 2015. We can see that it was, very, very high. We're not going to use a number this high. The maximum we're going to use is 20%. So, no upcoming major lawsuits. As far as I know, they didn't have any lawsuits at that time. Lawsuits can definitely drive you bankrupt. So you want to watch out for lawsuits. You do not want to invest in companies that have almost like a weight dangling over their head in terms of lawsuits. I would definitely avoid. And as far as I know, they didn't have any huge lawsuits at that time. The government likes or has no problem with the business or industry. So you don't want to invest in a company where the government hates you. They're just going to cause problems. In 2016, as far as I know, Apple didn't have any huge problems with the government. Now, there's a lot of regulation surrounding Meta and Alphabet and so forth. When you're choosing to invest in those companies, always look at what the government's attitude is towards the company. If the government's attitude is overly negative, I would stay away. Future predicted rate of return is greater than 20%. In order to do this, in order to calculate what your future predicted rate of return is, what we have to do is we have to take the earnings per share and project it out 10 years' time, figure out what a good multiple is for those earnings per share based off of the growth rate, and then look at what that future value is going to be and compare it to the present value. So I'll show you basically how to do it. So we're looking for companies that are going to 5x within 10 years. 5x within 10 years. Now, what we're going to do is we're going to take the earnings per share. Earnings per share, actually we'll do the annual. Normalized and diluted earnings per share annual in 2015 was $2.31. And what we're looking to do is grow these earnings per share 10 years out. at our growth rate that we decided on. Now, we decided on a growth rate of 20% because it was conservative based on Apple's historical growth rate. So we're going to do 1.2 and project out what Apple's earnings per share are going to be in 10 years' time. And we can actually compare that right now to Apple's current earnings per share. So in 2015, we said it was $2.30. So that means now we're going out 10 years. So we go out 1, 2, 3, 4, 5, 6, and we can see actually now 6, I believe it would be in 2022, and we can see that it's not too far away from the value that we got in 2022. $6.90 is what we projected from 2016, and in 2022 it's $6.11. So this was 6, so 7, 8, 9, 10. So we're getting a future earnings per share of $14.30, meaning we're projecting that in 2026 Apple will be earning $14.30 per share. I'll show you how we did that again. We took the earnings per share in 2015, which is the data that Warren Buffett had in 2016, and projecting that they're going to grow at 20% per year, which is conservative based on the growth rate that we've seen. And we're projecting it out 10 years. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So $14.30 per share. We're going to multiply that by a multiple that's equal to the growth rate. So if we're growing at 20% per year, our PE ratio is going to be a 20. So times 20, we're getting a future share price in 10 years' time for Apple at $286 per share. So what this is saying is that if we were to buy Apple in 2016, what we're projecting is that in 2026, Apple will be worth $286 per share based on its $14.30 per share. $14.30 per share earnings. So what we're saying is that in 10 years' time, Apple is going to be $2.86 per share. Now, keep in mind, this is based on 2015, projecting out from 2016 to 2026. And what we're looking for is for companies that are at least 5 baggers. Warren Buffett paid $34 per share, so divided by 34. So that means Warren Buffett is expecting Apple to be an 8 bagger, at least, which is above a 5 bagger, obviously, which means it's going to be a pretty good investment. So that's why he really bought it. Also, because as you can see, he paid $34 per share, and he's anticipating it's going up to $286 per share in 10 years' time. So that's basically how he did it. Now, what we can do is we can look at the accuracy using the current information that we have. So the way that we do that basically is we're going to take the information that Warren Buffett had. So he saw that it had $2.31 per share, projecting that it's going to grow at 20% per year. What we can do is we can project out to 2022 to see what the price should be currently and compare that to what the price is and see how accurate this actually is. So what we're doing is we're growing $2.31 per share at 20% per year. This was in 2016. So 2016, 2017, 2018, 2019, 2020, 2021, 2022. We're projecting out 7 years. So we'll do it 7 times. So 1, 2, 3, 4, 5, 6, 7. Now we times that by our multiple, which is 20. And we can see that Apple should be trading currently or sometime within this year or last year at about $165 per share. And that's exactly what Apple did, because if we look at the price, we can see that just not too long ago, Apple was about $160 per share. So this is a very accurate method. So what this is saying is in 2022, Apple's $165 per share roughly, and that's exactly what happened. It was $165 per share. They were in around. Obviously, it's not to the dollar. It's plus or minus a small percent. So that's that point of the checklist. Our future predicted return is greater than 20%. We can explain the company's moat. I mean, that kind of is self-explanatory with Apple. I mean, they have a product or service that people really love. And the company has a wide moat based on all these things, the return on equity, the profit margin, increasing earnings per share, and consumer mindfulness. Current ratio is above 9%. That is the case. The durable competitive advantage we just discussed. And, these things here, you can read through them. Basically, we're looking for companies that don't have a lot of problems in terms of their employees and so forth. But basically, the most important thing to look here is we looked at Apple qualitatively, quantitatively, and we determined what a good rate of return is for us, which is above 20%. Apple meets all those criteria. It has great management as we evaluated. Therefore, Apple should be a really good investment. That's what Warren Buffett was taking in 2016. Obviously, it worked out extremely well for him. As you can see, it went up from $34 per share, all the way up to now $125, and obviously it was much higher than that earlier. And so I hope this video was informative. I hope you learned what Warren Buffett looks for, what I look for, what you should be looking for when investing in a company. I showed you my own personal checklist. I hope you found it useful. I hope you found it, you can definitely copy it and use it for, yourself. I walked you through most of the steps. I'm not going to walk you through every single one. Some of them are self-explanatory, but I hope you found this video informative. Please like, comment, and subscribe. And I'm going to put out more information hopefully in the future. Thanks.